Hey everyone, we are the Joseph team. Welcome back to our latest episode. Today, we are going to be going over the 3 things that you can do to improve your credit score, what your credit score contains, and just how it impacts your mortgage. So I'm your host, Maddie Maloney.
And I'm Joe Sambear.
And I'm Sam Feda.
So one of the main things when you're going to get pre-approved or pre-qualified and starting the process, one thing that people typically don't know is that their credit score has a major impact on what they are qualified for and what mortgage that they can be approved for. So we really want to dive into what your mortgage credit report contains and how you can improve that score if you know the number comes in a little bit low and you want to improve it, either to get a better rate or be qualified for a better program, and what that all contains. So I think, Sam, can you start us off with diving deep into what is your mortgage credit report? And one thing real quick, I do want to say we are not credit experts. We do not qualify ourselves as credit experts, but we have seen hundreds of credit reports and know how it works. And so we're just here to give our advice on, the scenarios that we've seen before. So Sam, if you want to start us off.
Yeah, absolutely. Thanks, Maddie. So with the mortgage credit report, so that's obviously a big topic, one of the main points that goes into a mortgage. So with the mortgage industry standard is what's called a tri-merge report. So basically what that means is the tri stands for 3, obviously. So it's Experian, Equifax, and TransUnion. So we pull all 3 credit reports from each bureau. And then, along with the score is what's on there is the credit history. So that takes into account, on-time payments, any derogatory information on there. But really the main score we look at is the middle of the 3 to price the loan out. So, we're looking at the history as well as the score. So, along with that is the big factor of getting your rate is that credit score. So, Joe, what is the, how does the credit score actually impact your mortgage?
Yeah, so how it impacts your mortgage is we're going to get that, as you've indicated, the tri-merge credit report, which in my opinion, it's almost like a report card of how you've handled your finances over the last several years of things that are actually reporting. So that would be your auto loan, your installment loan, credit cards, student loans. Other bills might not be on there. So like your utility bills usually don't report, your rent usually doesn't report. Sometimes you can have it reported, but it's very unusual that it's on there. And so we're going to look and see, okay, how have you paid? Have you paid on time? How's your credit utilization? And then we're going to use that report with the middle score, as you indicated, that will decipher what your interest rate's going to be. So Fannie and Freddie, the housing agencies, FHA, the government agencies, they have kind of set up a standard of what is acceptable credit and how that will affect your interest rate. It will also impact your mortgage insurance. So if you're not putting 20% down, credit score has a huge impact on the rate, the cost, how much per month you're going to pay in mortgage insurance. So really how it impacts your terms is going to be the rates and the mortgage insurance, and how it affects your provability when we run it through an underwriting system, automated underwriting system, whether it's Fannie Mae again or Freddie Mac. It's going to indicate the risk level, and it's going to use that credit report in its entirety as a indicator of your ability to repay, and it has a huge impact on your approval or denial.
And one thing I've been seeing more of too, which you mentioned about, and this can kind of go along with one of our topics here about, what you can do to improve your credit, is I've been seeing a lot lately where, borrowers, when we pull credit, they'll actually have their rental history reported to the credit bureaus. They'll have utility bills, it shows self-reported utility bill to the credit, and that, can have an impact on the credit as well, because it shows you have that ability to pay on time, even though it's not your traditional auto loan or credit card. So that's one factor that can help improve the credit too.
And a good impact as long as you're making those on-time
Exactly,
payments,
yeah.
which is one of the main things, just making sure you're making on-time payments. And so when we had talked about, on-time payments and when a late payment shows up, when is it officially late in the eyes of the credit bureau?
That's a really good question, Maddie, and one we get quite a bit. So if you're getting a credit card statement and the due date is the first of the month, and you pay it on the second of the month, the credit card company is going to charge you a late fee because you're a day past the due date. But in terms of being 30 days late from the credit reporting agency, it's going to be when you're actually 30 days past that date, the due date.
So you don't actually have any derogatory credit until it's 30 days past due.
That's right. So that is a common misconception, let's say.
Definitely. One other misconception that I think a lot of people have is that if they have a banking app or a credit card app that gives them a general score of where their credit is, they think that that is going to be their mortgage score. So how does that score that they see, with whatever banking institution that they use, how is that going to differ from what their mortgage credit score is?
Well, there's something called a consumer score. So some people will either get it from their credit card statement or their banking institution, but there's also they also can pay for that through Equifax, Experian, TransUnion. To when they're monitoring it, they give them a consumer score, which is not the same score that banking institutions use to lend.
Exactly.
So we do see a pretty significant difference.
Yeah, there's usually a pretty big spread that I see from the consumer side to the institutional side that we see. Usually the consumer side's quite a bit higher, so that's a frequent conversation I have where, they said, my credit was 780 when I'm really seeing more like a 720, 730. So that can definitely be a difference there.
Well, you mentioned a score, Sam. So, what is a good score? What is reflective of excellent credit? What's the standard?
Yeah, so the top tier, is really anything over a 760. The scores range from 300 to 850. So, it can vary, the loan products that you qualify for based on your credit score. So top tier is really anything above 760 again. And then, as you start getting down into the low 600s, it might be a little more difficult with your traditional financing, but there's, programs for the lower credit borrowers as well.
And I will say, when you're getting your mortgage credit score back and it's not a 740 or 750, I don't think I've ever seen something, or I'm sorry, 840 or 850. I don't think I've ever seen something that high. I want to hear what you guys say, but I feel like the highest mortgage credit score that I've ever seen was like a 821 or something like that. So I just want to say, if they're expecting to get the stellar mortgage credit score, it's okay if it's just over 800. That's still amazing.
Yeah, and I think what people see is that FICO score usually is pretty high. So anyone with perfect credit, they're seeing that 850 or way up in the high eights where it's not really reflective on what we'll see.
Yeah, and like Sam said, once you cross that 760, there's really no need for a higher score. It's not going to impact your terms.
Exactly.
And if you're listening to this and know that your score is in maybe the 500s or low 600s, we want you to take this that it's okay, there's hope, and after some time and after working on it, you will be able to get to a point where you can increase your credit score. You don't have to stick with that low credit score forever. There are ways to improve it. So now I want to go into 3 things that someone can do right now to help their credit. So, Joe, I want to start with you. What is one thing that someone can do right now if they're listening to this, know that their credit score isn't the best and they want to apply for a mortgage within the next year? They want to get into the best mortgage product. They want to get the best rate, the best mortgage insurance. What can they do right now to help set them on the right path?
The quickest way to improve your credit score, in my opinion, is credit card utilization. It's something you can control, something you can do immediately, and it'll have an immediate impact.
Yeah.
And so what that means is if you have a credit card limit of, let's say, $1,000, what ideally the credit bureau's agencies want to see, they want to see 30% utilization max. That's the ideal goal, is to be under 30%, meaning your balance on that credit card should be $300 or less. And if you can stay under that 30%, that will have a significant impact on your score. What can be very confusing for some consumers is they go in and pay their credit card payment or balance off every month. And so they assume that their utilization is excellent. But you have to remember a credit report is a snapshot in time.
Exactly.
So it doesn't report that you pay it off every month. It reports what's your balance the day we pulled it and the last time the credit agent or the creditor reported the balance. And so that is definitely a misconception. So I would say before you have your credit report pulled, take a look at all your credit card balances. Try to get that utilization. It doesn't have to be under 30%, but the closer we get to that, the much better your credit will be. And if you are maxed out, just do the best you can to start bringing it down. Even, making it 50% utilization would make a big improvement.
And would you recommend to, like, if you could, applying for a larger credit limit with certain credit cards to make that spread bigger?
If you can control your debt.
Yes, exactly.
Yeah. No, so if you can control yourself and control your debt, it's you have to be careful about that. But yes, it is good to keep a higher limit and a lower balance.
Exactly.
And anytime you can do that, that's the other reason we usually recommend not closing your accounts. Not only do you lose all the great history you had, so if you had 18 years with a credit card company and you close it, you lose all those 18 years of history to a degree, and you're changing your balance to limit utilization ratio. So we like to see, even if it's a zero balance, try to keep it that way and leave that limit out there.
So, Joe, you hit on a good point there that I don't think a lot of people know affects their credit score, is that how long you have those credit cards open for, the term that you've had an established credit history with them really has an impact on your credit score. So if you opened up a credit card maybe just to get their 12 months, zero interest or whatever great program that they had, and then you close it after that 12 months, that is going to negatively impact your credit score because now you only have a year history with that company, where maybe it would be beneficial just to keep that open so that you can have continuing credit history and showing that you've had these cards open for a while. That was one thing that I really didn't know starting off. I thought, you could open and close cards as you want as long as you're making a good on-time payment and not having any late payment history on it. But it's really seeing the length that you've had these cards open and creating that history. So I will say, if you're someone starting off trying to build your credit score and you've opened a couple different cards, because it is good to have a few different trade lines open, and you see it negatively impact your credit score because now your length of the history of having credit isn't as great, it's going to be okay because over time that will improve. And so do you guys have any comments on that as well?
Well, the other thing about opening a retailer account like that has a promotion is what I've seen in the past. People with stellar credit have commonly made a mistake of opening and closing them, like you've indicated. But what also they do is they forget.
Yeah.
So they go to the retailer, they get offered the promotion, they take the promotion, they have all their credit cards and bills paid on auto pay. And then all of a sudden, they're not looking for that retailer's first bill. And we've seen many lates because they just opened it and shut it and they kind of forget about it. So that's the other risk that's out there, is when you're doing that a lot, there's more frequency to have an accident.
Forget about things, yeah.
So we know about credit card utilization now. And we've kind of talked about reviewing and monitoring your credit score, but what are the best ways to do that and to monitor your credit score? Because you're not always going to go out and get a mortgage or apply and get a hard credit pull every year. Definitely not the best for your credit. So if you're just someone that wants to keep check and make sure they're on the right path, what's a great way to monitor where your credit history and where you're at currently?
Yeah, I would say there's a lot of great apps out there, that you can use on your smartphone. One of them being Credit Karma. I recommend that to a lot of my clients because it'll actually give you 2 of the 3 scores, and it will give you the full history, exactly what's going on with your credit. It'll give it to you in real time, so if you miss something, it'll give you all the information to each creditor, to contact if there is a derogatory account on there. And also there's another one that's annualcreditreport.com. And that one, you can actually, it doesn't give you the score, but those are directly from the bureaus. And you can get the full history from each bureau, TransUnion, Equifax, and Experian. So I recommend pulling those every 3 to 4 months, just one at a time throughout the year to, verify what exactly is on there, see where you can make improvements, and just definitely stay mindful, because in the end, if you do need credit and you don't pay attention to it, you're going to be paying a lot more in interest over time with a lower credit score than a higher credit score.
Definitely. And with that annualcreditreport.com, that's just a one pull a year that you're able to get all of those.
You can pull from each bureau once per year.
Once per year.
So you can pull TransUnion once, maybe in January, then Equifax in July, and then maybe pull the other one at the end of the year, just to make sure it hasn't changed.
And that is treated as a soft pull. It's not
Correct.
a hard inquiry, so it has no negative impact on
Yeah,
that.
that's another misconception.
And with the Credit Karma, the one other thing, Sam, I think with that, you will be they will advertise to you.
Oh, yeah,
so
that's what you gotta watch out
Be prepared
for,
the
too.
advertisements. But
Yeah.
if you can
Good
get
call on
past that, it also alerts you, and that's that's a very important tool. It'll say, did you open this account at Best Buy or any retailer?
Yeah.
Is this you? There's been activity on your account? And it is a very helpful tool from that perspective.
Oh, yeah.
It lets you know every time there's
Yep.
an inquiry.
Especially nowadays,
Yeah,
how
yeah.
rampant fraud is. And if you're really nervous and really want to make sure that nothing's happening to your credit report, you can always go on and freeze your accounts if you want to make sure nothing's happening there. But definitely, I love using Credit Karma. I love being able to track everything. And it's also a great place that has all your credit cards together so that you can look at that and be, yep, I remember I do have this other card that I hardly ever use, but let me just go check, make sure I'm making on-time payments for that. So everything is in one area. So you don't have to really try hard to remember that or make reminders. Everything's in one area, which is really great. Okay, great. So Joe, so we've been through 2 ways that you can do right now to help your credit. Make sure you have good usage of your credit card utilization. You're reviewing and monitoring your credit report each year using some of the features that Sam had stated. What is one other way that someone can help their credit report right now?
Student loans. The other thing we see very commonly is a borrower or consumer will have a student loan that they believe is being deferred, but the student loan company is not reporting it that way. They're not showing it officially in deferment. It's actually rolling lates is what ends up happening.
Yeah, we've seen that a
and
lot.
so, and it's usually, my experience, it's usually not the consumer. It's not the follow-up checking to make sure it was properly documented and actually went and is being reported in deferment.
Because a lot of times you change your address in college a handful of times, you lose the bill, they don't know how to get a hold of you, and it just falls behind and you don't realize that you have all that debt.
And there's been changes with just what's going on in the world. There's been changes where they've allowed longer deferments. And so there's a lot of moving pieces there. So you just really need to check in. Even if you think you're in deferment, you need to maybe log into your account and see, is this showing deferment? And if it's not, if it's showing a payment due, you need to contact them.
Yeah. And one thing too, I've seen a lot that can negatively impact the credit, speaking of student loans, is, a lot of these student loans, you will borrow $5,000, but then the interest will capitalize. So if you're going to school for 2 years, at the end of that 2 years, when it becomes into repayment, that interest goes on top of that $5,000. So you could actually owe $6,000. So that will, kind of similarly to the credit usage with the credit cards, it'll show that you're over the limit in a sense. So that can really hurt your score. What do you recommend with that?
Well, that's a really good point, Sam. That's what you really would want to do is maybe slowly make some of those interest payments so it's not accruing like that.
Exactly.
Maybe you can't pay the principal right now, but try to stay on top of the interest, even on a monthly basis. It'll be not a huge payment, but it will keep you in a better position.
Keep the balance down to keep the score up.
Definitely. Awesome. Well, I think those were some really great tips. So today we've learned what your mortgage credit report is, how your credit report impacts your mortgage, And then 3 things that you can do right now to help your credit. So watching that credit card utilization, reviewing and monitoring your credit score often, and then keeping an eye on those student loans. So thank you everyone so much. We hope that this was helpful, and we hope to catch you on the next episode of Real Take Real Estate with the Joseph team.